Welcome. Today is September 23rd. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily Five. The Daily Five is the show where we take a look at the five most important charts to us this week. So let's get started. So over the weekend, we published our usual Alpha Insights weekly playbook. And we took a little bit different track to our analytical approach. And we did what's known as the Ben Franklin decision table. That's where you take a look at all the pros and cons of an important decision. And the decision we're really looking at right now is whether or not it makes sense to remain bullish on the equity markets. So we listed the top 5 reasons to be bullish. We came up with a variety of reasons to be neutral or hedge. And then also we looked at the top 5 reasons to be bearish. Now, the bear case has always been pretty obvious. Valuation's extreme. We've got concerns about peak earnings growth. You've got big tax policy changes on the horizon. There's a Fed tapering that's imminent. And then, of course, we're heading toward the debt ceiling cliff at the end of this month, and that could potentially be a catalyst. The bull case has really been a lot more hinged on really 2 factors. Number 1, technical trend, and number 2, policy support. And there's a couple other issues, the whole idea of, TINA, there is no alternative to equities, and money on the sidelines and things of that nature. But at the end of the day, it all boils down to trend. And as of Friday the 17th, when we wrote the report, the trend remained positive. But Monday's sell-off brought this into question. So let's take a little bit deeper dive on the trend and look at our first chart for the week. So chart number 1 is complicated. I may have shown this before in the past, but to the left, we have a longer-term weekly view. This is primary wave 5 that began March 23rd, 2020. So basically at the bottom of the sell-off during the COVID crisis in March of 2020, that low constitutes primary wave 4, and the entire advance off of that low is primary wave 5. And what we saw in primary wave 5 is just a very discernible trend channel up and to the right, following the 100-day or 20-week moving average and the 50-day or 10-week moving average very, very nicely. As it stayed above those moving averages, we could be relatively confident that the trend remained intact, despite what was going on in terms of the daily noise. But as we approach the most recent peak, which was achieved on September 2nd, we noticed going into that a diverging, or I should say a different pattern, a pattern where we had converging trend lines that looked very similar to an Elliott wave pattern known as the ending diagonal triangle. And anyone who knows Elliott wave knows that an ending diagonal triangle only comes into play when we are terminating a trend at one larger degree. And so since that ending diagonal triangle came in at a degree of trend known as intermediate wave, the next degree of trend is primary wave. And so since the entire advance was primary wave 5, we effectively terminated that once the price action broke through the lower boundary of those converging trend lines, which you can see in the blown up version, which is a daily chart. So the left is a weekly chart. The right is a daily chart dating back to early May. And we can see that advance off of intermediate wave 4 to intermediate wave 5 shows up as an ending diagonal triangle. And once we broke through that lower boundary, we also hesitated. We built a bit of a base there and then broke down below the 50-day moving average for the first time sustainably in many, many months, going back to really November of last year, or I should say October of last year. Now it looks like the market has held the 100-day moving average, and that's not surprising. That was really kind of the next area of intermediate trend support. But the thing that's different this time is that we made the very first lower low since the entire advance began. You can go back on that weekly chart and look back, and you can see that every subsequent low was higher than the prior low until this one. So we broke that. And by definition, a downtrend is a series of lower lows and lower highs. And so far, that's what we have since September 2nd. Now we've added some Elliott wave annotations here, and we're counting this down as minor wave, I should say intermediate wave 1 down and intermediate wave 2 up. Now, a very common retracement level is a Fibonacci 61.8% retracement. We are pretty much exactly there right now. So in our opinion, we are putting in the top of intermediate wave 2 down. And once that terminates, we should see intermediate wave 3 down ensue. And typically the third wave of an impulse pattern or motive wave is the most dynamic and most impactful. So we should see a fairly substantial decline. And we're estimating the initial support of that decline will come in around, say, 4170 plus or minus 20 handles in either direction. So that's our view of where we are looking at trend. Now, let's take a look at some additional supporting evidence that might make this view credible. So the next chart takes a look at market breadth. And we ran this chart last night based on the S&P 500, and we looked at the percentage of stocks in the S&P 500 that are currently trading above their 50-day moving average as of yesterday's close. That's the top panel in the chart, and as of yesterday it was 37%. That's kind of an alarming figure because it's the lowest level we've seen this year, and it's below 50%. And anytime the breadth of participation above the intermediate term trend is below 50%, it's a reason for concern. Now, the lower panel takes a look at the longer term trend. The longer term trend is the 200-day moving average. And at this point, we saw that peak back in mid-March at around 95%. Since that time, we've come down to just above 69%. Now, we haven't cracked the 50% line just yet, but we're knocking on the door. And anytime we start to see participation wane below at least 75%, it's reason for concern when we're talking about the long-term trend. I'd also like to bring your attention to Bob Farrell's rule number 7. If you don't know who Bob is, Bob was the chief market technician at Merrill Lynch for many, many years, decades, and he is a legend in technical analysis and one of the most influential people in the discipline in terms of my career and thinking. And Bob's rule was this, rule number 7, that is, markets are strongest when they're broad and they are weakest when they're narrowing to a select few blue chip names. And it's very clear that the names that are holding the market up at this point can be counted on your fingers on one hand. And that's Apple, Microsoft, Google, Amazon, and Facebook. And we saw Facebook lose a lot of ground yesterday. So in my opinion, we're starting to see some slippage there in terms of that blue chip leadership. Let's take a look at chart number 3. So we've talked about trend reversal. We've talked about the narrowing of breadth. Well, here's another way to think about it. The advanced decline line is basically the cumulative number of advances minus the cumulative number of declines. And what we want to see is that advancing stocks outweighing declining stocks when we're in a bull market. And the way that we determine that is that the advanced decline line confirms the advance in price by making a new high as price makes a new high. So in other words, advancing stocks are confirming the advance in price. And what we have in the top panel is the S&P 500. And we can see in the lower panel that the NYSE advanced decline line, there's 2 versions of this. There's the all issues version, which includes preferred stocks, closed-end bond funds, and really all manner of bond proxies. And then there's the common stocks only, which only includes NYSE listed common stocks. And so Both of them are diverging, but we want to focus on the common stocks only at this time, because it's very, very clear that the common stocks only version of the NYSE AD line peaked on June 8th. And since that time, it has made a series of lower highs as the market has made new all-time highs. On September 2nd, when the price of the S&P 500 peaked, we saw a much lower peak in the NYSE AD line for common stocks only. And that divergence is interesting because every divergence of this nature since 1957, when the S&P 500 came into existence as we now know it, has been followed by a severe market correction of 10% or greater. Now, not every market correction has been preceded by a divergence, but every divergence has been followed by a correction. So the fact that the AD line is diverging and the fact that we're only about 4% off the highs from peak to trough so far on the S&P leaves us with the idea that we may have more to go on the downside. So it's validating our concerns on the trend. Let's take a look at chart number 4 to get a little bit additional perspective. What chart number 4 is showing us is a Dow-Theory Non-Confirmation. Now, for those who don't know what Dow-Theory is, let me just give you a little quick lesson on technical analysis. One of the core tenets of the discipline of technical analysis is that key indexes and sectors should advance together and confirm one another's progress during a bull market. And there's really no intermarket relationship that's deemed to be more important than that which exists between the Dow Jones Industrials and the Dow Jones Transportations. And what Charles H. Dow, the founder of the Wall Street Journal back in 1889, famously observed was that when the Dow Industrials were advancing in a bull market phase and making new highs, the transportation index would also make new highs to confirm it. And what Dow deduced from that was that, well, when industrial companies, the manufacturers of goods, were seeing greater demand for their products and greater profitability, we would also see greater demand out of those companies that transported those goods, mostly the railroads and shipping companies back then at the time. But now it's the FedExes and UPSs and logistics truckers and things of that nature. But you know, the relationship is the same. And when Dow said basically that if the transports weren't confirming the industrials, then the demand pull through for the production wasn't there. And so what we're seeing right now in the chart is on the top panel, the Dow Jones Industrials, which made its all-time high on August 16th and has since turned down, was not confirmed by the transports, which made their all-time high back on May 12th. And so the transports put in a lower high. Now, what's also interesting is that in mid-June, both the Dow and the transports made an interim low. And since that time, we've seen the transports break below that pretty convincingly at this point. Now, the Dow Jones Industrials, while trading below their 20-week moving average or 100-day moving average, has not broken below its June lows. It looks like it's directionally committed to do so. And so what we're watching for to get a Dow theory quote unquote sell signal would be for the industrials to close below that June low that they put in place just as the transportations do. And once both of those confirm that break, that would be what's known as a Dow theory sell signal. So the non-confirmation is reason for pause. A sell signal would be reason for selling. Now let's take a look at the last chart, chart number 5, to give us some additional perspective on where we are within the cycle. So we've been following the 2021 Cycle Composite. For those who don't know what that is, it's an equal weight aggregation of the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle. The model line in the chart left is blue, and the actual S&P 500 price action is in kind of a gold dashed line. And you can see I've marked "you are here" as of yesterday's close on that. And so, the red bars that you see, the vertical lines, actually show the period from August 1st to October 31st. That's the period we're mostly concerned with. And the reason for that is it is historically the worst performing 3-month period of the year seasonally. But what's more important is that when you combine that with the first year of a president's term in office, like we're experiencing right now, and also with years ending in 1 in the decennial cycle, the performance gets particularly hairy. So we looked back in time, going back as far as we could from 1928 to present. And each year ending in 1 shows relatively poor performance during this period, and especially poor performance when you look at first year of a president's term, where we had that situation occur. And the first time was 1941. It was Roosevelt's 3rd term, but the first year of that 3rd term. In 1961, it was Kennedy's first year of his first term. Reagan in 1981, first year of his first term. Bush in 2001, the first year of the first term. And now we have Biden in his first year of his first term. And in the past, those years ending in 1 were very poor. In the case of Roosevelt, down 8.5%. Kennedy, not bad, positive 2.79%. Reagan saw 6.9% decline. Bush a 12.5% decline. Of course, we had 9/11 then. And the question is, how will it end for Biden? And the jury's out. We'll let you know on November 1st. But the mean return during this period was minus 5.56%, the median minus 3%, and the low was down 24.03%. And there's about a 66% chance that we'll have a down 3-month period. So, at this point, we think with the model having topped August 6th and now pointed hard down into late October, given all these other circumstances, we believe the correct action for investors at this point is to play defense. And we said going into this downturn, it was time to take profits. We say at this point now, if you haven't done so, you've been given a second chance right here. It is time to take the chips off the table. What we think we're experiencing right now is a counter trend rally into key resistance at the 61.8% retracement level. And the next move should be hard down into late October. So with that, I do want to say that you can contact me for more information on my website, jwhinvestment.com. If you're interested in taking a look at the full report that we published on this, you can go to my website and request a 30-day trial, and I will send you the report, and we'll send you all the reports we publish for the next month, absolutely free. And if you like what we're doing, you want to subscribe, then you're free to do so. With that, I would like to wish you all the best of luck trading, and thank you for your time today.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.